Kentucky Housing Corporation may soon offer the Shared Appreciation Mortgage, SAM, a zero-interest, deferred-payment second mortgage, providing up to 25% of the purchase price for first-time homebuyers buying newly constructed homes.
Welcome to The Explainer. Today, we're unpacking a brand new housing initiative that could completely flip the math for new buyers in Kentucky. We are looking at the Kentucky Housing Corporation's Developing Shared Appreciation Mortgage Program, which you'll hear me call SAM for short. It is a really fascinating new tool designed to provide massive down payment help for first-time buyers. Okay, let's dive into this. If you've been keeping an eye on the housing market lately, you absolutely know the struggle. High home prices, elevated interest rates, closing costs, and mortgage insurance, they all kind of combine to create this massive wall, keeping first-time buyers out. But what if you could get up to 25% down on a newly constructed home without adding a single cent to your monthly mortgage payment? Honestly, it sounds like the ultimate affordability dream, right? Well, that's exactly what the SAM program is aiming to do. But as we're going to see, it comes with a very specific built-in trade-off. Now, what's really interesting about this slide is how our roadmap lays out for today. We'll start with the first-time buyer challenge, define what the SAM program actually is, and then really dig into how repayment works. From there, we'll cover who qualifies, the new construction rule, and finally, help you figure out if SAM's right for you. Starting off with Section 1, the first-time buyer challenge and exactly how we overcome that massive affordability gap. Let's be real, the barrier to entry for home ownership has just gotten incredibly steep. For most folks buying their first home, saving up a traditional 20% down payment is nearly impossible. And because of that, buyers usually have to take out a much larger first mortgage and then get hit with private mortgage insurance, or PMI. PMI is basically just an extra monthly fee that protects the lender, but it offers literally zero financial benefit to you. It's just a frustrating extra cost. What buyers in Kentucky desperately need right now is a tool that lowers that first mortgage amount, completely wiping out the need for PMI. Which brings us perfectly to Section 2, the solution. What exactly is the SAM program? According to the Kentucky Housing Corporation, or KHC, SAM is a zero-interest, deferred-payment second mortgage. It pairs seamlessly with a few specific conventional first mortgages, namely the Fannie Mae HFA Preferred or the Freddie Mac HFA Advantage loans. The absolute key terms to remember here are zero interest and deferred payment. This means that while you're actually living in the home, you are not making monthly payments on this second mortgage, and it is not quietly racking up traditional interest month after month. And the sheer scale of this assistance is honestly what makes it such a game changer. SAM can provide up to 25% of the purchase price. Just think about what that does to your purchasing power for a second. Applying 25% down dramatically lowers your loan-to-value ratio, meaning you owe much, much less compared to what the house is actually worth. That eliminates the need for PMI completely, lowers your monthly payment, and really strengthens your overall loan approval. To really wrap our heads around this, let's stack SAM up against traditional KHC down payment assistance, or DPA. Traditional DPA typically offers up to about $12,500, and it usually comes with a fixed repayment schedule and a monthly payment you have to manage. SAM, on the other hand, scales with a purchase price up to a whopping 25%, has zero monthly payments, and zero traditional interest. But notice that last difference there. Traditional DPA has a fixed repayment, while SAM involves shared equity. So the crucial point is found right here in Section 3, how repayment actually works and that big trade-off. Because look, SAM is not just free money, right? It is not a forgivable grant. In exchange for all that upfront help with zero interest and no monthly payments, you agree to share a portion of your home's future equity growth. When the loan eventually becomes due, you have to repay the original assistance amount plus a proportional share of the home's future appreciation. Basically, the percentage of appreciation you share is exactly equal to the percentage of assistance you received upfront.
And this brilliantly illustrates how the math actually plays out in the real world. Let's say you buy a newly constructed home for $200,000, and you receive SAM assistance equal to 20% of that price, which is $40,000. Fast forward a few years, and you decide to sell. The market value is now $240,000, meaning your home has appreciated by $40,000. Because you got 20% in upfront assistance, you owe 20% of that $40,000 appreciation back to the program. That comes out to $8,000. So, at closing, you'd repay the original $40,000 plus the $8,000 share for a total repayment of $48,000.
So when exactly is that check due? Well, the SAM second mortgage gets triggered by a few specific events. The most common one is obviously the sale of the property. But repayment is also required if you transfer the title, pay off the first mortgage entirely, execute certain refinances. Now, there is an exception for one permitted rate and term refinance, but generally speaking, refinances trigger it if you face a formal notice of default or if you hit the final maturity date of the loan. It's also super important to note that when you repay this money, it doesn't just vanish. It goes right back to replenish the SAM program pool so that future Kentucky homebuyers get the exact same opportunity. Moving right along to Section 4, who qualifies? Think of this as the borrower filter. Since this is a highly specialized program, it's got some pretty rigid requirements, so let's see if you fit the mold here. First off, you must be a first-time homebuyer. Second, your income cannot exceed the 80% area median income limit, which is going to vary depending on your county and household size. Third, you've got to have a minimum credit score of 660. Fourth, your maximum qualifying debt-to-income ratio can't go over 50%. And finally, you have to complete a SAM-specific homebuyer education course. It's expected to run about $35 through eHome America. And listen, there's really no wiggle room here. If you have a 650 credit score or you make even slightly over the income limit, you do not qualify. You've got to hit every single one of these criteria.
Next up is Section 5, the new construction rule. This is the property filter.
Just like the borrower rules, the property filter is incredibly specific. The SAM program is explicitly designed to accelerate the production of single-family housing across Kentucky, so it is strictly for newly constructed homes. To be unequivocally clear about this, the property must have a 100% new foundation. Existing homes, rehabbed homes, or older flipped properties do not qualify for this program. It has got to be newly constructed from the ground up. But as long as it's newly constructed with that brand new foundation, the program is actually kind of flexible on the type of housing. Eligible properties include your standard single-family residences, single-family homes that feature an accessory dwelling unit or ADU, manufactured homes provided they are on a permanent foundation and converted to real property, and even owner-occupied duplexes. Let's move to and see how this builds into Section 6. Is SAM right for you, and what are the next steps? Okay, first things first, the Kentucky Housing Corporation currently has a big work-in-progress label on this SAM program. The final guidelines are still being ironed out behind the scenes, and mandatory lender training isn't even scheduled until July of 2026. What that means is this program is definitely on the horizon, but it's not sitting at the closing table today. Buyers, real estate agents, and builders all need to verify the final requirements directly through KHC and their official All Regs manual before ever writing up a purchase contract that relies on SAM funds. Which really leaves us with this final critical question to help you evaluate your own financial goals. Are you willing to share your future equity to unlock your first home today? Because that is the ultimate trade-off of the Kentucky Shared Appreciation Mortgage Program. It offers a massive reduction in upfront costs, lower monthly payments, and total elimination of PMI, making a newly constructed home an immediate reality. But in exchange, you're giving up a slice of your future wealth. For many folks out there, bridging that affordability gap today is absolutely worth sharing a piece of tomorrow's appreciation. For others, maybe it's not. Take some time to evaluate your goals, keep a close eye on KHC for the official launch, and make the choice that builds your best financial future. Thanks so much for joining me on this explainer, and keep learning.